Hello, options traders, and welcome to the weekend update. So the weekend update is by design late this week, and the reason it's late this week is I kind of wanted to wait and see if anything happened on this whole debt ceiling issue, and if anything did happen, how the futures market might open up here on Sunday. So that has happened. There was a pseudo resolution to the situation, or a short-term resolution. They kicked the can down the road a little bit, I guess is my take on it. And we'll look at how that seems to be impacting the futures right now. However, before we get into that, as always, I like to review the P&L, the equity curve of our closed trades. So a couple weeks ago, we made a new high here, just a little over $16,000. We'll drop back off that just a hair, did close out a trade this week for a small loss, and you'll be able to see why here in a moment. But the thing I want to really point out is I launched this service and started firing out trades back on December 1st of 2022. And again, we're up over, well over $15,000, just shy of $16,000 in profits on these trades. Of course, every trade I made is in the alert service, where those of you that are subscribers to the service can go look at every one of those every one of those trades in the closed trade archives. Excuse me. There's also a lot of learning to be done there, because each one of those trades, probably, I'm guessing over 100 of them now, I have the opening of the trade, a video that goes along with the opening, any adjustment, the videos that go along with the adjusting, and then the corresponding close of the trade for a win or a loss, and a little bit of a summary of the trade. So it's a great way to go back and kind of look through a series of trades and, maybe learn from them and or pass your own judgment on them. What the heck was Steve thinking here? Or, oh, that's a move I hadn't seen before, whatever the case might be. So again, that's unfortunately only available to subscribers of the service. So if you are a subscriber of the service and have been a subscriber of the service, you will have seen that the trades have generated, again, over 100% return. I mean, probably closer to, I don't know, maybe 110, 120%. Averaged about $400 a week. Now, keep in mind that this is not a steady, another week went by, I got a $400 paycheck. It doesn't work that way. So you have times when you'll have big weeks like this, then you'll have times when you'll give a little bit back, and then you'll have other nice wins and losses. And so this is an average of the returns that these trades have made over that period of time. So, and how did I calculate that return? That's always an important thing to understand. So, as most people know, if you've looked into my service at all, I try to base each trade at around or under a $2,500 capital allocation. So, in other words, when I put on predominantly butterfly trades, that's kind of my favorite trade, the go-to trade. That's the one that I personally trade largely for income and sometimes for hedging in an IRA, but for the most part, I use them for my income trading. And that's also what the deep dive butterfly class is all about, that kind of is designed to accompany this service if you're not familiar with butterflies. But at the end of the day, how I'm calculating this is each one of those trades will usually have about $2,500 in what I'll call max risk, or capital that has to be set aside for the trade, capital allocation. And I usually won't have more than 3 to 4 trades open. Sometimes I'll have as many as 5 trades open. And it is conceivable that there could be 5 trades open that might have $2,500 in risk each associated with them. Now, that's rare because usually as a new trade is opened with about $2,500 in risk, more often than not, I've thinned out some of the prior trades or locked in some profits on some of the prior trades to reduce the amount of exposure that those trades have. But in a worst case scenario, it could be a number around this amount. And so therefore, based on the fact that I could have had as much as, $12,500, or even stretch it and call it $15,000 out there in risk or capital allocation at any given time, that would still exceed a 100% return here in less than 1 year. So if anyone's interested in checking out the alert service further, you can go to sjgtrades.com, Trade Alert Service, and you can see more about it, how the service works, etc. So I'll put a link in the notes down below as well. And there is also a package that I'm offering. That package includes the deep dive butterfly class and 2 months of free alert service. I think it's a really, really phenomenal package to help kind of jumpstart people that are interested in doing this. If you don't understand the intricacies of trading an all-put butterfly, understanding what is the best market conditions to enter that trade, how might you adjust that trade in a rip-up market, how might you adjust it in a collapsing market, then there's about 4 or 5 key adjustments that someone should consider in an up market, and probably about 6 or 7 in a down market. And the ones that you would consider are going to vary depending on how long the trade's been opened, what the volatility of the overall market is, etc. So there's a lot of different things that kind of come into play here that are important to understand. And again, feel free to go take a look at the alert service there, and you can see more about it. And again, I'll also put a link down below in the combo package that's going to include the deep dive butterfly class, plus 2 months of the alert service at no charge. So let's get this out of the way and move on with our evaluation for this week. So this is, again, our equity curve. You just saw that. This is the same image. I just put some comments over the top of that. So this is our trades. I can come in and I can look at the bar chart of each individual trade, and we can see the profit and loss of each individual trade. Of course, we can also come in and we can see the list of these trades. This is the one that I just closed out this week for a loss. And the reason I did that, so this was a trade that was in the QQQs. It was a butterfly with a long call. The drawback to doing a butterfly in the QQQs or the SPY is that it takes a lot of options to do that. If I'm trading SPX, I can trade far fewer of them. In fact, in this service, when I put on an SPX trade, an SPX butterfly, I'm usually doing a 2 lot, and that will usually put me in under about $2,500 in risk. However, if we're doing a butterfly with a long call, and if you haven't traded those before, you may not fully understand this, but if we're doing a butterfly with a long call, 2 SPX butterflies is not a good number to be offset by 1 SPX long call. It takes more butterflies to offset a long call properly. Again, we get into this in the deep dive class and of course in the alert service here. But to show that trade, because it's a very good trade to know and understand, to show that trade, I'm making it in a smaller vehicle, the QQQs or the SPY, to where I can trade 10 or 15 butterflies. However, if I'm trading 10 QQQ butterflies, a butterfly is 1 long strike, 2 higher short strikes, and then a higher yet long strike. So 4 legs per butterfly. So if I'm doing 10 of them, that is 40 legs in this particular trade. Now, I do that all the time in SPX. It's a much larger vehicle, and but if I'm doing that in SPX, I could have, $15,000, $20,000 in what I'll call maximum risk or buying power that's been used up in that trade. And obviously, I'm not doing that here for the class. So I have to select a vehicle that has smaller notional value so that I can stay under the $2,500 self-imposed limit. And again, we have to have a number of butterflies, usually in the 10 to 15 range, to be able to offset it with a single long call. So that's the reason that I was doing these in QQQ and in the SPY, was to show people the logic and or the way that this trade works. However, the downside to this trade is when these require some adjustment. In this case, this required a complete rollback, so closing out one butterfly and then rolling that butterfly back down as our market sold off excessively. That one move, we had opened 40 legs in our first trade, and then we had to close that butterfly. We had to close 40 legs. Then we had to reopen another 40 legs further down in our market. So right at that point, we're at 120 different options that had to be open, closed, adjusted. And while I have a fairly low commission rate of about 35 cents per, a lot of people don't. And so I use, in all of my calculations here, I am using $1 commission. Now, I don't think anybody's paying $1 an hour. If you are, you need to have a serious talk with your broker. But I'm using that as a worst case scenario. So at the end of the day on this trade, I had already spent $120 in commissions on this trade, and I was needing to do yet another adjustment to this trade that was going to cost about another 40, 50, or 60 in commissions. Had this trade been in a much larger vehicle like SPX, where I had the potential of earning significantly more money on it, I'd do that in a heartbeat, wouldn't blink an eye. I have trades that I do that I could easily end up with $200, $300 in commissions in those trades, but those are trades that are also returning $4,000, $5,000, $6,000, so I don't worry about that. But again, when we have something here where the potential gains are so relatively small compared to the amount of commissions, I decided on this trade just to go ahead and pull the plug, even though I feel comfortable that I could have managed my way out of it. The cost of commissions to manage my way out of it just would have been excessive. And then if for some reason the market didn't cooperate with me and I ended up with a loss on top of all those commissions, that would not have been a good situation. So for that reason, I chose to close this thing out at a small loss. So that's part of the learning process. That's part of what we do as traders, is we look at those cost-benefit analysis. So that's our trades to date, all the closed trades. Let's look at what we've got open right now. So we've got a couple problem children here that are open, and we'll take a look at those, but they are improving significantly. So we've got our Google wheel strategy, which is a covered call. Well, it's selling naked puts and then moving to a covered call strategy. So this thing's just been clicking along fine. We've got this broken wing butterfly that we've had to adjust a couple of times. But again, this is an SPX, so it's a much larger product, and it's easier to move this around because this is only 2 butterflies, so our commissions are significantly lower when we need to adjust this thing. So this had been down, I think, as much as $700 last week after that monster market sell-off. This is gaining value nicely at this point, and this trade is currently positioned nicely. I do believe that unless the market does something real erratic, I do believe we'll get this trade into a profitable situation here in the next week or two. This particular trade is nicely profitable at this point. This also had required a number of adjustments along the way. We had to totally open up this downside when the market sold off, but it's decaying very rapidly now. We do have an order out on this one. I've got an order out to, actually this did thin last week. I think it thinned out on Friday, locking in some profits and reducing our overall risk. And we'll look at basically probably knocking the rest of this trade. I'll probably close the rest of this here this coming week. If the market cooperates and kind of chops back and forth around where it is here, I'm expecting I should be able to close this out for maybe a 15-20% profit over a couple weeks time frame. This P&L is not correct in here right now. Not sure why it's showing that, but it's a Sunday, it's after hours, so I don't worry about that. That's fairly typical for numbers not to show up accurately after hours, especially when we have a trade that is this far out in expiration. So this thing doesn't expire until November 17th. So plenty of time on this trade, but this trade actually right now is at about a break even. It is not down. This trade was just put on this last week. Market did sell off a little bit after the trade, which increased volatility slightly, and it did give us a slight little hint of some loss in this trade, but the positioning in this is perfect. This yellow line is where our current market is. That's exactly where I like the market to be on this broken wing butterfly. As soon as the markets open up on Monday, we will see that this is at about a break even, maybe even slightly positive if our market opens up a little bit with volatility down a little bit. Don't let this number scare you either. Okay, so this is Apple, and again, not sure exactly why that's showing up, but if I blow this up and we take a look at it, we're definitely down in this trade. So this is a trade that I'm showing people. The class voted on this one as to how I was going to manage it. Basically, Apple ripped up. I had on a call spread, or excuse me, I had on a put spread. The market ripped down, and I got assigned 300 shares of Apple. So at that point, I asked the students, how would you like to see this play out? How would you like me to work this? This is my whole goal here, is to provide education, and I wanted to know what would be the most helpful from an educational standpoint for students. And it was a unanimous, or virtually unanimous, I think one person had an alternate opinion, but it was virtually unanimous that they wanted to see me work through this. So I got signed 300 shares, and so I started selling calls against those 300 shares. And each time I sold a call, I took in additional money. So when I sold my first call, I took in, I don't remember the exact amount, well, it was $4.64 because I'm up $2.42 on this trade, and there's still $2.22 that it's worth. So, I sold this for $4.62. $4.62 times 3 is $1,200. So I took in $1,200 in credit selling these calls. The market sold off. So when it sold off, I'm losing money on my long stock. I know that. But this is gaining money. Well, it sold off quite a bit. So I decided, you know what? I'm going to sell another call, or in this case, 3 calls. So I sold that. And if we add these two numbers up, it would have been the $1.22 plus the $3.38. So that would be about $4.60. So I sold these for $4.60. So again, brought in another $1,200 and some odd dollars. It's the combination of those two $1,200. I'm going to turn the rest of this off. It's the combination of those two $1,200 that's going to decay, and over time, as this decays, that's what gives me this potential profit in this trade. So that will take me from where I'm at right now of down roughly 1,000 to, if I carry this all the way to expiration, I would be up a decent amount. I won't carry it to expiration. That's not my goal here. But that's what the students wanted to see me work through. Now, last week, this trade was down about, I want to say about $1,400. So this adjustment, if you will, this way that I am working my way through this trade at this point is paying off. And I do think I will either be able to work this maybe to a profit or at least to a much, much lower loss here over the coming weeks. So those are the trades that are currently out there and where they are at. So again, just to kind of recap, nice profit here, nice profit here. This one is break even. Do not look at that negative 780 number. That is not accurate. This number right now is probably accurate from a loss standpoint. And this number is close to accurate for a loss standpoint. But I do believe that both of these are trades that can largely be salvaged. By salvaged, they can probably be worked into some profit. I think this one probably more likely to be worked into some decent profit. This one may be a little less likely, but I've got an alternate plan I'm looking at on this one that could greatly improve the juice or the theta in the trade that I may share with students this week. And if they like that concept, I may implement that concept this week. So again, normally I'm doing the trading, but in rare instances, when I'm faced with a choice, I like to ask the students, what would you like to see? So anyhow, that's kind of where we're at on this, and that's our current positions as they exist. And now I'd like to get into just a brief summary of our actual markets. So what I wanted to wait for specifically was the futures to open up today. Now, when our futures opened up, again, we've got this quote-unquote pseudo resolution to the debt ceiling, and I did expect that that would cause a little bit of a higher opening, and it did. We jumped from, again, this is in the futures market. SPX won't open until tomorrow morning, but the futures give us an idea of what traders are thinking over the weekend. And the futures closed at 43.30. They opened here this afternoon on Sunday at 43.50, so that's about a 20-point increase. Then it's kind of sold off, and this is really what I would expect in this situation. Bottom line is that we're not out of the woods in a lot of different areas, but there's going to be traders that tend to trade off news that are going to see this, and they're going to think, oh gosh, our problems are solved. I'm going to run out and buy the market long. And so they're willing to pay up whatever number on the open because they just want in because they think we're going to take off from here. And again, maybe, but I don't see that being the case. I would expect a gap up and then probably a little bit of a selling into that gap, which is exactly what's happening here and what I think is likely to happen when the SPX opens tomorrow. Again, unless some additional news were to happen to come out. So at the end of the day, this is going to bode well for all the different trades that we currently have open. If we look at a chart here as well in our SPX, and let's see here, let me pause a second. Oh, no, it's coming up. So as I had mentioned previously, these yellow lines are they're Fibonacci lines. They create a channel, and this is kind of where I would envision the low side of our market to probably be and settle for a number of reasons. One, there had previously been very heavy resistance here that was finally popped through. Former resistance tends to become support, so we've got that going for us. Got this long trend upline that we are resting on right now. And then we also have this blue line, which is a 200-day simple moving average, which is a big number to large institutional traders. That's a big indicator that they often tend to look at as a buying point. But also, if we break down hard through that 200-day simple moving average, it's largely called what's known as a death cross. And that's not a good sign if we close down below that and stay down below that a couple of days. But more often than not, we come down to that and we tend to bounce off it. That's what seems to happen more often than not. So we have a number of things that are all coming into confluence right in here, which leads me to believe that we are likely to stabilize, maybe chop sideways, maybe rally back a little bit. If we rally back, a typical rally is going to be about a 50% retracement, which is probably going to put us up in here into this, 44.30 range. So at the end of the day, my expectation for the next couple of weeks is that we might rally up here to 44.40, 44.50, somewhere in there. We might dip down to this 4,200 range. So that's going to be kind of the range that I am expecting and that I'm playing for. Without taking into account anything really abnormal that happens in our markets. Obviously, when that happens, all bets are off. We need to kind of see what happens, where the market settles out, if there's some big announcement or something big that happens. The main thing that is important for people to see, particularly for butterfly traders, and again, if you haven't taken the butterfly class or you're not familiar with it, I'm not a big promotion guy, but I am telling you that there's certain things that make the butterfly trade much, much juicier. You get a much higher reward to risk ratio. It's a much better time to enter a butterfly trade when your implied volatility, you can see that right here, this light blue, is above your historical volatility. When this happens, that means there's a level of fear in the market where traders are buying more puts than normal. They're going out there and they're ensuring their accounts, when they start buying up, paying up, and insuring their accounts, that's when I want to step in and say, I'll sell you that insurance. If you're willing to pay a higher amount for your insurance than normal, that's when I want to step in. And the fact that we're doing this, and again, I apologize if you aren't familiar with this concept, but the fact that I am selling you that insurance, I'm selling you puts that you want to buy to protect yourself. But then as part of the butterfly, I'm also buying long puts down below the price I'm selling to you. So I'm kind of reinsuring myself. I'm able to decide the amount of risk that I want to carry in a trade based on selling you at one strike and then going out and buying something else down lower. This is exactly what insurance companies do. Your farmers insurances and travelers and those companies of the world, if they go and they write a whole bunch of fire insurance, for example, in Southern California, or hurricane insurance in Florida, they don't want to carry that whole massive risk themselves. So they might go out and sell $5 billion worth of insurance, but then they go and they buy $4 billion worth of reinsurance from Lloyd's of London or some other very large commercial carrier, so that they, the company, farmers, travelers, whatever, is only on the hook for whatever portion they decide they're comfortable with. And for them and for us as options traders, when that volatility is higher and we're able to get more money for our insurance policies, that's when it becomes more profitable. So, and that's all kind of what's spelled out in the deep dive course. Again, my goal here on this weekend update is not to, it's not to pitch the deep dive course, but at the same time, for somebody looking to understand the skills required here, it is something worth considering. So with that, I'll wrap up the weekend update. Sorry it ran longer than expected, and I'm not sorry it was later than expected, because again, I did want to see what was happening here so I could comment on it when I put this out. So all of you in my group, we'll see you this next week. And those of you on YouTube, thanks for checking it out. Please like, subscribe, comment. I appreciate it. And take care, everyone.